Hello friends, this is Vijay Bhambwani here and I'm back with you in this weekly market outlook. What we saw in the last week was the Bank Nifty underperforming the Nifty 50 and falling in percentage terms harder and further than the Nifty itself. Now, what's really pulling the Nifty down is the fact that banking and financial sector services are very heavily weighted in the Nifty itself. Banks themselves constitute over a third of the entire weightage in the Nifty 50. So as you can see, unless the banking space picks up, I think the Nifty will find it a little challenging to hit 16,000 and go beyond it. So let's take a deep dive into what's happening and what we can expect in the coming week. On your screen is the market roundup window, which shows that the headline indices fell and the rising US dollar also exerted its pressure on bullion and also kept oil prices under check. But gas prices flared up on higher offtake. And while the US dollar index rose in the international markets, the USD INR fell, which is good news because it shows that the rupee is relatively outperforming the US dollar. It showed relative strength. Now, the 10-year benchmark bond yields fell marginally because the RBI announced a GSAP or the Government Securities Acquisition Program on 22nd July. Now, we'll come to that in a bit in the 10-year benchmark bond yield segment itself. Now coming up on your screen is the MWPL or market wide position limits, which show signs of plateauing out because the week on week gains have been fairly small. But that's kind of expected because the impending expiry of the July futures series weighs on the traders on the coming Thursday. Now that is of course routine. Now look at the basis chart on your screen. On a week-on-week basis, the basis fell. Basis is nothing but the premium enjoyed by the future over spot. Now that is routine that the basis returns to zero on expiry day. But the Nifty saw basis inversion, which means the future is actually trading lower than the cash, which shows some kind of selling pressure from delta neutral hedgers, people who buy in the cash market and sell in the futures to hedge those delivery based investments. Now, coming up on your screen is the cumulative stock and index futures volumes, which means these are July, August and futures series volumes all put together. Now both categories, stock futures as well as index futures, rose, but the action was clearly on individual stock futures, which means trader participation was higher on a week-on-week basis. Now, higher volumes are always welcome because they cut down the bid and offer spreads and the impact cost for both intraday traders as well as systems-based traders. Now look at the impetus chart on your screen. This shows a rise in the velocity or the acceleration in momentum on both indices. Now this is not exactly great news here because the impetus or the velocity has risen on a week when prices were bearish, which means the downside gained a little bit of acceleration. Now this is not exactly an earth-shattering development. It can change hour to hour or day to day, but keep monitoring this aspect very, very keenly. Now, like I said, it's only a minor worry. And do note that the impetus is our in-house study from our statistical model, the Barracuda, and soon we are commissioning IBEX, our intraday trade identification support systems, which we'll use in-house. And of course, I'll be happy to share the output on my social media accounts with my friends here. So some more in-house studies coming up on your screen. Look at how the FIIs raised their longs in stock futures to 9,302 lots, which was 1,603 lots last week. And they cut their index futures longs to 28,547 lots from 53,538 lots, which means the FIIs are trading light. They are keeping a light touch in the future space. Now for DIIs, or domestic investment institutions, they cut their index future shorts marginally to 48,848 lots from 51,200 lots last week. And they raised their stock shorts. Now this is noteworthy. They raised their stock future shorts to 11,80,669 lots from last week's 11,69,509 lots. Now the DII seem to be pressing sales, or short sales rather, even on price declines, and they remain the largest short position holders in the futures segment on the NSE. Now let's take a look at prop traders. These are brokers, individual own trades, as well as specialists who are supposed to have a better grip on the markets. Now they raised their index futures longs to 17,833 lots, which was 5,596 lots last week. And they reduced their stock futures longs to 1,75,433 lots from last week's 1,82,929 lots. Now, they are playing a cautious hand ahead of the expiry on Thursday, which was kind of expected. But now come the retail traders. Remember, these guys are the biggest bulls, the holders of biggest long positions in the markets. And what did they do? They raised their index futures longs to 2,468 lots. Last week, they were net short of 7,934 lots. So from minus, they've come to plus. But they reduced their stock longs on a week-on-week basis to 9,95,934 lots, which was earlier 9,84,977 lots. Now this is kind of partly attributed to the impending expiry on Thursday, and since the retail guys are the biggest holders of long positions, they are taking a head-to-head opposition with the domestic investment institutions, the DIIs, their positions in the future. So far, the retail guys have prevailed over the sentiments, and they are doing a good job at it so far. So keep it up, guys, and keep supporting the markets on dips, and maybe you can even take it higher in the coming week. Now, friends, let's take a look at a market that I love watching, because this is the source of all money, and this is the asset class that drives the prices of the other asset class. I'm talking of the bond market. Coming up on your screen is the 10-year benchmark bond yield, which fell to 6.16% from 6.20% in the prior week. The unfortunate part about our market is that people don't understand the bond market well enough, nor do they even bother. Now, this market being the fountain of all money supply, and the cost of that money, which is in bond market trader parlance, is called the coupon rate. Very simply said, it's the interest rate. This market not only decides how much money will come or not come, and if it comes at what price. Now that in turn determines the prices of all other asset classes, like I said. And I've recorded a very detailed video on the Equity Masters playlist, which I would strongly suggest you watch and subscribe to. The hyperlink to my Equity Master playlist is in the description below this video. And I put up 4 videos out there every week, which I urge you to watch and subscribe to the channel. So I've recorded a detailed video on Equity Master, how the RBI should be allowing you to access its bond trading platform very, very shortly. And both the primary and secondary markets are areas where you can invest and trade for free. Now that will change things around because you will get higher yields. You're cutting the middlemen out, the brokers and the mutual funds where you would invest in the debt schemes. So your yield is likely to go higher. And you will also see the RBI getting some help from the retail public in targeting their 12 lakh crores of money raising which they intend in this financial year from the bond market. Now, the most critical aspect to watch is at what price or what coupon rate the government is going to borrow at. If rates rise, the banks will have to raise fixed deposit interest rates also, and their cost of funds will rise. Now, that was the primary reason why the Bank Nifty underperformed the Nifty 50 last week. So please keep watching the 10-year benchmark bond yield, no matter what anyone tells you, even otherwise. So you need to have a 360-degree worldview edge over your other contemporary traders, and that's exactly what my videos and this channel is for, to kind of put you ahead. You might even be a couple of weeks ahead of the market, and sometimes it might appear that what you're thinking is not really transpiring or materializing in the markets, but that's fine. As long as you're ahead of the market, it's all just fine. So do connect with me on my social media pages where I share all this data. In the end of the day, late evening, the contact coordinates will come at the end of this video. Now, friends, let's take a look at the Dixie, the US dollar index, which is a benchmark index of the US currency against the global basket of currencies. Now, this is another critical factor to watch by all emerging market investors and traders, because it impacts their country's balance of payments and also the imported inflation aspect. So whatever they import becomes more expensive is the dollar is stronger. Now, watch the daily chart on your screen. The Dixie is headed towards the previous swing high of 93.5 levels approximately, which will prove to be a near-term hurdle. And unless this hurdle is overcome convincingly and sustainably, the bulls may have to wait for further upsides. The price here remains above its 25-day exponential moving average, which means the near-term outlook also remains positive for now. And the weekly chart on your screen, on the other hand, shows the price remaining comfortably above its 25-week exponential moving average, which makes the medium-term outlook also positive. The 91.5 level is a short-term support to watch, and this index assumes importance, particularly due to rising oil and gas prices, which I call multiplier commodities, because if oil and gas prices go up, everything from fruits, vegetables, transport costs, everything goes up. And if the dollar was to firm up, the already firming up oil and gas prices will become even more expensive. So keep watching this space very, very carefully. Now, the coming week is likely to see an estimated, I stress upon the word estimated here, range between 93.90 on the upside and 91.90 on the downside. Friends, let's now go to the Bank Nifty, and this index fell on 2 out of 4 trading sessions and fell further and harder than the Nifty 50. The fact that the impetus rose, which we saw earlier, is a mild concern, and the price has fallen below its 25-day exponential moving average by a small margin, which shows on the daily chart on your screen. And that implies that the near-term outlook is that of wait and watch. We need to have a breakout above the 36,000 level round figure, which will put the bulls back in the driver's seat, and that is what we must wait for. On the flip side, staying below the 25-day exponential moving average is a sign of concern, and that is something we must watch carefully. Now, coming up on your screen is the weekly chart that shows the price is above its 25-week exponential moving average, which means the medium-term outlook is also positive. And the candle formed is a doji, which means there was an active pull and push between the bulls and bears during the week, but the closing was very close to the opening levels. Now, only a sustained upthrust or a vicious drawdown will clear the air on which party will dominate the sentiments, whether it's going to be the bulls or the bears. Now, in the week gone by, this index was number 5 on the most volatile list, but rose 2 notches to number 3 because beta rose sharply. I told you the banking space has been very frothy, very choppy. And the coming week is likely to see an estimated, I stress upon the word estimated, range between 36,450 on the upside and 33,625 on the downside. I would suggest, my friends, you trade on light exposure because volatility is likely to stay elevated. Let's now go to the Nifty 50, which, as you can see on the daily chart on your screen, seems better compared to the Bank Nifty because the daily chart is structurally showing higher relative strength. The price is staying above its 25-day exponential moving average, which means even the short-term outlook is positive as long as the price stays above this moving average. Now, a sustained trade above the 15,900 is a must before fresh upsides can be seen. Now, let's take a look at the weekly chart. The price is above its 25-week exponential moving average, which makes the medium-term outlook positive. The candle, which shows on the weekly chart, is bearish, but it is fairly small, which means the fall was relatively mild. Approximately, I'm using the word approximately here, the 15,400 level will act as a support that must be watched in the coming days. If the bulls are managing to defend this level successfully, they have a good probability of taking a chance of hitting the 16,000 levels in the coming week. Now, in the week before last, this index was number 15 on the most volatile list, but it fell to number 20 on the rankings thanks to the narrow trading ranges intraday. And the coming week is likely to see an estimated, I repeat the word estimated, range between 16,275 on the upside and 15,450 on the downside. Like the Bank Nifty, on the Nifty also you should be trading light because the Jensen's measure seems to indicate an even chance for bulls and bears because the markets are still seeking clear directions. Watch the commodities, bonds and forex markets keenly in the coming week because they will exert an influence on the price. Friends, the indices done. I now come to the most popular segment of this video wherein I give you 5 stocks that are high beta, high impetus, where you take small exposure, wait for big price moves, and I'll give you 5 stocks that are low beta, low impetus, where you take big exposure and take wait for small price moves. Different traders' aptitudes, different strategies. So the high beta, high impetus stock list is led by Jubilant Foods at number 1, Escorts at number 2, number 3, Mahindra & Mahindra Finance, number 4, L&T Finance, and number 5, Cholamandalam Finance. Now, low beta, low impetus stock list is led by HPCL, number 1, number 2 is TCS, number 3, Granules, number 4, Ramco Cements, and number 5, Bajaj Finserv. Friends, this hierarchy can change from day to day because volatility intraday ranges shift with sentiments daily. Do connect with me on social media wherein I update a lot of this statistical stuff in very, very simple layman's language. My contact coordinates come up at the end of this video. So, if you liked what you saw in this video, I would request you to subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comments section, I would love to hear from you as to what you feel about our work that we put up out here. Thank you for your patience. Thank you for watching my video. Do take very good care of your trades and investment next week. Till we meet again in my next video, this is Vijay Bhambwani signing off for now. Take care. Bye-bye.